Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last video I have explained you about the meaning of the term financial management, the importance of financial management, objectives of financial management, and the important area of financial management, that is risk and return. The meaning of risk, the meaning of return, types of risk and return, and the relationship between risk and return. That is the basic thing about financial management. So I have already explained you in detail. Remember, the formula, the problems are based on the theory. So don't ignore the theory. If you are strong on the concepts, on theory, definitely you can easily understand the problems. Otherwise, your problems knowledge will be baseless, without any foundation. That's why. So if you have not watched the last video, I suggest you to go to the playlist of my channel, select the subject financial decision making, select the video of financial management, watch the initial videos, be perfect on the concepts, then only we can start the problems. Now in this video, I am going to explain you about the financial instruments. What are the financial instruments which are issued by a company to raise the funds? That is the main topic of this video, so watch the video till the end. So before starting the video, take a screenshot of the points which I have written on the board, then I'll explain all the points in detail. Now, our topic is the types of financial instruments. When a business wants to raise the funds, it has different options, different instruments available. Through different instruments, a company can be able to procure the funds, raise the funds. So one by one, every source of fund will have their own features, advantages, limitations. We cannot say always this source of fund is better. Every source will have their own advantages and limitations. A company has to evaluate which source of fund is suitable or appropriate at the present situation. So first source of fund are debentures. The debentures are the debt instruments. It is a debt indenture. So a debenture is a document which is issued by a company under its common seal, acknowledging that the company has taken a debt from the holder of this security. Holder of the security. So it's a debt instrument, meaning the company has taken a debt from the public, from the debenture holder. In return, the company will pay periodic interest payment, and on maturity, the company agree to repay the principal amount. That agreement is written in an indenture. That is called a debenture, right? Simply, a debenture is a debt instrument which is issued by a company under its common seal, acknowledging that the company has taken a debt from the person and the company promises to pay periodical interest and repayment of principal on maturity. That's it. This is debenture. Now, what are the features of debenture? It's a loan instrument. Remember, the person who purchases debenture is not the owner. He is only a lender. So the company has taken a loan on the basis of this debenture. So this debenture is a loan instrument on which interest has to be paid. Secondly, fixed income security. Another feature of the debenture is the interest rate on debenture is fixed. At the time of issue of debenture, the company has specified that this debenture will carry a rate of interest of so and so for a so and so period. Then fixed term. Every debenture has a fixed maturity period. At the end of maturity period, the company will refund or return the principal amount to the debenture holder. Fixed period. The next one is normally secured. When debentures are issued, it will be issued on the security on some assets of the company. That is called secured debentures. But theoretically, unsecured debentures are also there, which do not have any security. But normally, The debentures are issued on the security of some specific assets or on all the assets. Then next one is no voting rights. The debenture holders are outsiders. They are not the owners. They don't have any voting right in the regular course of the business, regular conduct of the business. They cannot interfere. They are outsiders. They simply has lended the money to the company. In return, they will get the interest. If their interests are affected, suppose if the debenture holders' interest is affected, then they can vote. But otherwise, normal circumstances, a debenture holder cannot take part in the voting of the business of the company. So these are few features of debentures. Now, types of debentures. Debentures are classified on the different basis. The first basis of debenture is on the basis of convertibility. On the basis of convertibility, debentures are classified into three categories: fully convertible, non-convertible, and partly convertible. Fully convertible debenture means the debentures which can be converted into equity shares after a specific period of time. That means at the time of issue, the company has declared that these debentures are convertible. After a period of 5 years or after a period of 10 years, the holder of the debenture holder will have the right. The holder of the debenture will have the right to get converted the debentures into equity shares. If this right is given by the company to debenture holder, the debentures are called convertible debentures. Next comes non-convertible debentures. Specifically, it is given that these debentures will remain debentures only till maturity. It will never be converted into equity shares. It is called non-convertible. Partly convertible, sometimes a company will issue debentures. In that, the right is given only 50% of your debentures can be converted into equity shares. Remaining 50% will remain as debentures. This is called partly convertible, partly not convertible. So in this way, on the basis of convertibility, debentures can be classified into fully convertible, non-convertible, or partly convertible debentures. Similarly, on the basis of security, debentures can be classified as secured debentures and unsecured debentures. Normally, what will happen when the company issues debenture, the debenture holders or the lenders want some security. The company will say, we will provide the security on a particular asset, or we provide the security on floating of all the assets. In that case, what will happen? The debenture holder are secured. They will say, if the company fails to pay interest, if the company fails to pay the redemption amount, then they are having the right on the assets of the company. The liquidator will first of all have to sell away those assets and realize the amount. That amount will be paid to debenture holder. That means debenture holders are secured. They are having the security on the assets of the company. These are called secured debentures. And normally secured debentures will have a lower rate of interest. Now, unsecured debenture, where the company has not provided any security to the debenture holder. Debenture holders are unsecured. That means whatever amount they have invested, they don't have any security on the assets of the company. That is called unsecured debenture. Then the rate of interest on unsecured debenture will be normally high compared to secured debenture. Next one's on the basis of registration or transferability. On the basis of registration, debentures are registered debentures or unregistered debentures. In registered debenture, the company will maintain a register in which the name and details of the debenture holder will be written. The interest will be paid only to those persons whose name exists in the debenture register. Otherwise, no interest will be paid. So whenever a person purchases a registered debenture, he has to make a transfer deed. He has to submit this transfer deed to the company. The company will write the name of that new debenture holder in the debenture register. So the data of all debenture holders will be maintained by the company. That is called registered debenture. Unregistered debentures are also called naked debentures. That means the company will not maintain the details of the debenture holders. Debenture holders have no registration form. In that case, The debentures are accompanied by interest coupon. They have to produce interest coupon and they will get the interest. No registration is required for transferring the debenture from one person to another person. But these are very rare debentures because a lot of risk is attached with these debentures. Next comes on the basis of redemption. On the basis of redemption, debentures are classified into redeemable and irredeemable. Redeemable debentures are those debentures where the company has declared the period of time. For example, the company has issued the debentures and stated that this debenture will be redeemed after 10 years. After 10 years. So as soon as the 10 years are over, the debenture holder has to return back the debenture to the company and get back the amount refunded. That is called redeemable. And these are the common type of debentures. Second, irredeemable debentures. That means the debentures will not be taken back by the company until and unless the company passes a resolution to take back the debenture. That means specified period is not stated. There is no specific period after which the debentures will be taken back. That is called irredeemable debentures. So these are the different types of debentures. So what I have discussed, what I have explained to you, the meaning of the term debentures, what are the features of debentures, and what are the different types of debentures. In examination, very frequently a theory question may be asked regarding these instruments. They may ask you, what do you mean by debentures? What are the different types of debentures? What are preference share? What are the different types of preference share? What are equity shares? And what are the features of equity shares? These are the things that in examination question may be asked. Next comes meaning of bond. Actually, bond and debentures are very much similar. Normally, debentures will be issued for a shorter period. Bonds will be issued for a longer period of time. Both will have the same features. Features means the debenture holder or bond holder will get fixed rate of interest every year. The debenture holder or bond holder will get back their principal amount on maturity. The debenture or bond holder will not have any voting rights in the company, in the corporation. Then what is the difference? The difference is normally debentures will be issued by corporates, whereas bonds will be issued by government or government undertakings. That's it. Remaining all the features are same for bonds or debentures. Next comes preference share capital. The second instrument. First instrument, debenture, I have explained. Second instrument, financial instrument, is preference share capital. First of all, meaning of preference shares. Preference shares are those shares on which there is a preferential right to get the dividend and preferential right to get the repayment of capital on winding up, on liquidation. So if any share is carrying two preferential rights, then those shares are called preference shares. The first right, dividend should be paid first to preference shareholders, then to any other shareholders. Secondly, at the time of liquidation or at the time of winding up of the company, the preference shareholder should have the right to get the capital returned first. Later on, capital will be returned to other shareholders. If these two rights are there, those shares are called preference shares. And preference shares will have a fixed rate of dividend. Fixed rate does not mean that every year the same rate of interest, same rate of dividend will be paid. If the company has earned profit, then only it will pay fixed rate of dividend. If the company incur losses, there is no obligation to pay fixed rate of dividend. This is the meaning of the term preferences. What are the features? The first, preference over equity. The very first feature of preference share is the preference shareholder will have a right to get the dividend before any dividend is paid to equity shares. Secondly, the preference shareholder will have the right to get their capital back on liquidation before any capital is returned to equity. Second, no permanent. See, equity share capital is permanent. Permanent means always, as long as company is not wound up Till that time, equity share capital will be attached with the company. But preference share capital may not be permanent. That means it will have a specific period. After a specific period, it will be redeemed. The preference shares may be redeemed, but equity share will not be redeemed. That is the difference. Not permanent. Fixed rate of dividend. Equity shares will not have the fixed rate of dividend. It will fluctuate with the earnings. More profit, more equity dividend may be paid. Less profit, less equity dividend will be paid. But on preference share capital, the rate of dividend is fixed whether the company has earned more profit or less profit. Next comes not obligatory to pay dividend. Fixed rate of dividend does not mean that every year fixed rate of dividend will be paid. In particular year, if the company incur loss, there is no need to pay dividend to preference shareholders. Then do not carry voting rights. There are no voting rights. Voting rights are there only for the equity shareholders. Preference shareholders normally do not have any voting right except in a case where their interest is affected. When the preference shareholders' interest is affected, they can come and vote for their particular interest, not for the general functioning of the company. So these are some of the features of preference share capital. Now types of preference shares. Just like types of debentures, we have types of preference shares. The first type of preference share is cumulative preference shares. The cumulative preference shares are those shares where dividend will get accumulated if not paid earlier. Example, in a particular year, the company do not have sufficient profits. So company has not paid dividend on preference shares. In the next year, suppose if the company is having profits, then it has to pay dividend of last year as well as current year. Last year accumulated dividend and current year's dividend both will have to be paid if the preference shares are cumulative. If the preference shares are cumulative. Example, if last 3 years dividend were not paid to preference shareholders, last 3 years, then current year dividend has to be paid for the current year and also for the last 3 years. It is called cumulative preferences. Second, non-cumulative preferences. At the time of issue of preference share, the company has specified these are non-cumulative preferences, meaning if in any year there is insufficient profit or no profit, the company will not pay any dividend and that dividend will lapse. The dividend will get elapsed. That means next year they will not get the last year's dividend. That's it. This is called non-cumulative preferences. Next come participating preferences. After paying the dividend to preference shares, whatever profit is left, the whole profit goes to equity shareholders. But in some circumstances, the company will pay only a part of the profit to equity shareholders, the remaining part is left. If the remaining part also the preference shareholders are having the right, they are called participating preferences. In simple words, after paying the equity dividend, if any profit is left, in that profit the preference shares are having the right, they are called participating. Similarly, at the time of winding up of the company, if the company has returned back the equity capital also, still some assets are left, some amount is left, then preference shareholders will also have the right in that surplus assets if they are participating. If non-participating preference shares are there, then whatever left out profit or left out assets, the preference shareholders will not have any right. The whole left out profit or left out assets will belong to equity shareholders, not to preference, if they are non-participating. Then convertible preference shares. Those preference shares which have right of converting it into equity shares. Sometimes a company will issue preference shares in that it is already stated that these preference shares will get converted into equity shares after a period of 10 years. Example. So till 10 years it will be preference shares. After 10 years the preference shares can be converted into equity shares. These are called convertible preference shares. Non-convertible, name itself is clear. The preference shares will always remain in preference. It will never be converted into equity. Redeemable preference shares. The preference shares which will be redeemed or taken back by the company after a period of time. The company has specified that this debenture will be redeemed after a period of 12 years or after a period of 10 years. So as soon as 10 years completed, the preference shareholders must return back the preference share to the company. The company will make the payment, principal repayment to them. That is the redeemable preference share. Irredeemable preference shares. The company will specify that these preference share will not at all be taken back by the company. That is called irredeemable preference shares. So what I have explained you, the meaning of the term preference shares and what are the different types of preference shares. Now the last topic is regarding equity shares. Equity share capital. So what are equity shares? First of all, meaning. The equity shares are those shares which do not carry any preferential right on dividend and right on equity capital. That means the equity shareholders will get the dividend only after making the payment of dividend to preference. If any profit is left after paying the preference dividend, that profit will go to dividend into equity shareholders. Otherwise, if no profit is left, no equity dividend will be paid. Similarly, at the time of winding up of the company, first of all, the capital of preference shareholders should be returned back. After repaying the preference capital, if any amount is left, that amount will go to equity shareholders. Residual ownership is equity shareholders. The equity shares are also called ordinary shares or common stock. They are the ultimate or real owners of the company. Real owners of the company, because they have taken the highest risk and they will get the highest return. They are the real owners. Now, features. The first feature of equity share, it bears the entire risk and enjoy entire reward. They are the residual owners. That's why they have to take the entire risk of the business and also they will enjoy the entire reward. So the risk and return both are higher for equity shareholders. Second, permanent or perpetual in nature. Permanent means this equity share capital will always be there till the liquidation of the company. It's a permanent capital. There is no redeemable equity shares. The shares are always irredeemable. Then residual capital. The capital is residual because after making payment to all the outside parties, if any amount is left, that amount will be given to equity shareholders. So they are the residual, last party to be settled. Next, carrying voting rights. The equity shareholders will have the right to vote on any matter of the company. So voting right will not be there in case of debenture holders or preference shareholders, but complete voting power is given to equity shareholders. Next is do not carry any security against the asset. We have seen that debentures will carry security. Secured debentures are there. The company has provided security on particular assets to debenture holders, but no such security will be given to equity shareholders. Equity shareholders are always unsecured. Next one is liability of shareholder is limited. Equity shareholders' liability is limited to the extent of the amount invested in the company. The loss incurred by equity shareholders is only to the extent of amount invested in the company, nothing else. The private property, the personal assets are not liable for the debts of the company. Last one, freely transferable. The shares of public limited company. The shares of public limited company are freely transferable from one person to another person. At any time, the equity shareholder can transfer his shares to another person in a stock exchange. In a stock exchange, they are freely transferable. So, these are some of the characteristic features of equity share capital. That's all. So, in this video, I have explained you about the financial instruments through which a company can raise the funds. The common instruments are debentures, preference and equity. All the three I have explained the meaning and also the features. Inshallah, the next topic will start in the next video.